Hello to all the debt warriors listening, and welcome back to another episode of Millennial Debt Domination. I'm your host, Katei. Today's episode will be an Ask Me Anything edition of the podcast, and I also won't have a guest on today's episode, so it's just going to be me. However, I'll have a few of our millennials and Gen Zers popping in from time to time to ask their questions. So I'm going to take this opportunity to answer some of these questions to wrap up the year. I'm looking forward to covering a wide variety of financial questions on the podcast today, so let's jump right in with our first question. It's been a while since we've talked about student loans on the podcast, so our first few questions are in regards to student loans. Since there was so much interest in student loans, I'll make sure to do an updated student loan podcast in the future. For now, our first question is from Allie. She's 25 years old and she is from Florida. She asks, I'm having a hard time budgeting my paycheck to include my student loans. What advice do you have to help me create a new budget that includes my loans? So this is such a common question because coming out of college, a lot of students have a hard time making a real world budget. This can be especially true if you're struggling to find a job after college. Whether you have a job or not, you're still going to have to make your student loan payments because if you don't, your unpaid student loan debt will catch up to you and affect your financial life negatively in so many ways. The good thing is you're granted a 6-month grace period from the time you graduate until you have to start paying off your student loans. So I suggest to use this 6-month grace period to get your budget together so you're prepared to start paying off your student loans when the time comes. So, okay, let's get to that budget. To start, determine your monthly income. For the purpose of your budget, it makes sense to use your monthly take-home pay instead of your gross income. This lets you track the earnings hitting your bank account. If you have more than one job or if you have a side hustle, be sure to account for that when determining your income as well. After you've determined your monthly income, track your spending. For instance, your spending categories might include utility bills, gas, groceries, entertainment costs, dining out, rent, going out with your friends, and most importantly, don't forget your student loans. Once you've figured out your total monthly income and expenses, it's time to balance your budget. You should be bringing in more money than you're spending. However, if your budget is unmanageable, look for areas where you can cut costs. If your income exceeds your expenses by a fair amount, consider putting extra money towards student loan repayment. This will help you save on interest charges and repay your balance faster. You can also fit your student loans into your own budget by enrolling in an income-driven repayment plan. So on this plan, your monthly payments are between 10 to 20% of your income after taxes. Payments can be substantially smaller and they can change annually. It's important to note that your loan term will be extended to 20 or 25 years. So it's important to consider that before enrolling in the income-driven repayment plan. If you don't want to enroll in this payment plan, find places in your budget to reduce your spending. Start with easy cuts. Get rid of subscriptions you aren't actually using, and you can even shop around for cheaper services like your cell phone plan. Then examine remaining bills. Are there services you could put a pause on temporarily? By reducing your expenses, you're making room in your budget for your student loan payments, which is extremely important. Make a plan to revisit your budget every 6 months or when your income and expenses change. You might decide you want to put more money towards your student loan payments or save for another purpose. Our next question is from Derek. He is 32 years old and he is from Virginia. He asks, how can I tell if my student loans are federal or private loans, and what's the difference between the two? Okay, this is another awesome student loan question. Your student loans will either be federal or private loans. You can log into Federal Student Aid website, which I will link in the description of this podcast, and use your FSA ID to see the list of all your federal student loans. On your account dashboard, you can find My Loan Servicers or check the National Student Loan Program system. If you're making payments to a lender that isn't listed, there's a chance your loan is federal. Now let's get to the difference between the two. The interest rate on federal loans is fixed, which means it stays the same. Private loans typically have an adjustable rate, which means that the interest rate can go up. Private loans tend to start with a lower interest rate, known as a teaser rate, to be more attractive to borrowers. Unfortunately, the interest rate doesn't stay that low. The undergraduate federal student loans may be subsidized, wherein the government pays the interest on the loans while you're in school for at least half time. Private loans are not subsidized. There are multiple repayment options for federal loans. Some of these options tie in your monthly payment amount directly to your income. Private loans don't typically offer multiple repayment options. Federal loans offer deferment and forbearance under certain circumstances. There are also federal loan forgiveness programs available to those who qualify. I recommend exhausting your federal loan options before taking private loans. If private loans are a necessity, please make sure that you read the fine print and understand what you're signing. Never borrow more than you absolutely need for education. If you have any questions regarding your student loans, you can call one of Navicor's specialized student loan counselors. As always, I will put all of Navicor's information in the description of this podcast so you guys can get all that information there. Okay, this next question comes to us from Facebook. It's from Sarah. She's 23 years old and she's from Connecticut. She asks, if I can't afford my student loans, what options do I have? Okay, if you can't afford to pay your student loans, contact your loan servicer to discuss your options. Your loan servicer can discuss options with you and help you stay in good standing with your loans so you can take steps to avoid student loan default. If you have federal student loans and you're struggling to keep up with them, another thing you may want to do is change your payment plan. Some different types of student loan repayment plans are the income-based repayment plan, which I touched on earlier this episode in the last question, the income contingent repayment plan, and the extended repayment plan. For a more detailed explanation of these types of plan, check the description of this podcast where I'll link one of our blogs that I go into detail about these plans and other types of student loan repayment plans. Another option you may want to consider is loan forgiveness. Through the Public Service Loan Forgiveness Program, federal student loan borrowers who work in public service at a qualifying nonprofit or government agency may have their loans forgiven after 10 years of qualifying monthly payments. And again, I have gone into detail about the student loan forgiveness program in a past podcast I did all about student loans. So I'm going to link that in the description of this podcast as well, so you can get that information there. Tax season is quickly approaching. I received a couple of tax questions, and now would be a great time to ask them. Our first tax question is from Dylan. He is 30 years old, and he is from Maryland. He asks, what is the head of household, and who is eligible to file their taxes as head of household? Tax season technically starts in January, so this is a great time to start talking about taxes and prepare you guys for going into the new year. So let's answer that question. Head of household is a tax filing status for single or unmarried taxpayers who keep up a home for a qualifying person. If you qualify for head of household, you'll have a lower tax rate and a higher standard deduction than single filer. Also, heads of household must have a higher income than single filers before they owe income tax. In order to qualify for head of household, you must be unmarried or considered unmarried the last day of the tax season. A temporary separation won't count towards head of household status. Next, you need to have paid more than half the cost of keeping up a home for the year. Finally, you need to have a qualifying dependent living in the home with you more than half the year. This is usually a child. We received a voicemail question for our next question, so let's hear it.
Hi, I'm Brendan. I'm 28 years old. I'm from New Jersey. And my question is, what is a tax refund and how can I use it to help my finances?
After you filed your taxes, you might receive a tax refund. A tax refund is a reimbursement to a taxpayer for any excess amount paid to the federal government or state government. Taxpayers sometimes look at a refund as a bonus or some kind of luck, but it most often represents an interest-free loan that the taxpayer made to the government by overpaying taxes throughout the year. Receiving a tax refund from the government is a great bonus for the year, but it's important to plan for this as expected income and not just blow it on one big spending spree. When thinking about your tax refund, think about ways this money can impact your financial life for the better. Take some time to think about your current financial situation as well as your short-term financial needs and wants. Use your tax refund to help with your finances by creating an emergency savings, paying down your credit cards, or investing in your financial future. Next up, I have some questions about credit, so let's go over some credit basics. Our next question is from Mallory. She's 27 years old and she's from Nevada, and she wrote this question to us on Instagram. So the question is, who are the credit reporting bureaus and what do they do? I love this question because the credit reporting bureaus are so important, yet not everyone even knows that they exist. The three credit reporting bureaus are Experian, TransUnion, and Equifax. The three credit bureaus know a great deal of information about your financial history. From the time you opened your first credit account, the credit reporting agencies have details related to you and your credit history. They collect all information about your credit account, including payment history, amount of credit you have available, and the amount of credit you're using. They also have details on your public records, such as bankruptcy, tax liens, foreclosures, and repossessions. Not only does a credit bureau know all of your financial standing, but they also have your personal information like your date of birth, current and previous employers, and your current and previous addresses. I have done an episode in the past where I chatted with Christina Roman from Experian all about the three credit reporting bureaus, from how they all started to what they all do, and so much details about the credit reporting bureaus. And it's so interesting. So I'm going to link that episode in the description of this podcast. And I highly recommend to give that episode a listen if you're curious about the credit reporting bureaus. Our next question came in from Twitter, and it's from Jamie, who's 24 years old from Ohio, and he asked, what factors make up my credit score? Okay, going back to some credit basics here, which is great because I never get tired of talking about credit basics. So your credit score is made up of 5 categories, and the first category is payment history. Paying your bills consistently on time is the largest factor in your credit score and is responsible for 35% of your score. Late bill payments will detrimentally affect your credit score the fastest. So scheduling your bills and making payments automated will ensure you don't miss a payment. Next up in your credit score is debt ratio, which makes up 30% of your score. Using less than 30% of your available credit is a great start to getting your credit under control. And if you can get your credit to debt ratio under 10%, then even better. Your credit age makes up 15% of your score. Keeping your accounts open and in good standing over time is an indicator of being a lower financial risk. The longer your accounts have been open and being used responsibly reflects well on your credit report and subsequently your credit score. Opening and closing credit cards is a bad idea if you want to build a strong credit score. Next up, we have hard inquiries, which account for 10% of your credit score. Just like opening and closing too many accounts, having too many hard inquiries on your credit report will have a detrimental effect. It's important to know the difference between a hard inquiry and a soft inquiry on your credit report. A hard inquiry can stay on your credit report for up to 2 years, but the effects on your score can wane over time. A soft credit check might be done by an employer before hiring you, and soft credit inquiries don't affect your credit score. Next, we have another question from Instagram, and it's from Isabella, and she's 21 years old from New York. She asked, how can I improve my credit score? Now that we know the factors that are included in your credit score, let's talk about how to improve these factors. So I kind of touched on some improvement methods in the last question, but I'm kind of reiterated here. In order to improve your payment history, pay your bills on time. If you don't trust yourself to pay your bills on time, set up automatic payments. This will ensure you never miss a payment and your credit score won't be negatively impacted. The key to the amounts owed segment of your credit score is to keep that ratio low. Don't charge up your credit cards near their limit. As mentioned earlier, keep your utilization below 30% or even 10%. To improve upon length of credit, keep your credit cards open as long as possible. If you don't use your card consistently, keep your accounts open and charge a small purchase on it every month. It's better to do this than close your account completely. Try to diversify your credit responsibly to improve your credit score. You can also improve upon your credit score by only opening credit when it's absolutely necessary. Our next question was emailed to us by Jack, who is 34 years old from Florida, and he asked, are there any resources available if my debt is too much to handle on my own? This is another question I absolutely love because it lets me highlight the great work that's done at Navicore Solutions. If you find your debt is too much to handle on your own, credit counseling may be just what you need. When searching for a credit counseling company, you should look for a nonprofit to work with. If you're having trouble managing monthly bills, take the first step by reaching out to a certified credit counselor who will work with you to gain an in-depth understanding of your unique financial situation and develop a personalized plan moving forward. Credit counselors provide unbiased advice for your individual financial situation and offer practical solutions to meet your needs. Credit counseling can change your life because the burden of unmanageable debt is lifted. Just being able to afford to order dinner out with your family can be a small moment of success. It's smart to seek professional help from a credit counselor to help pay off your debt. As I mentioned earlier, I will put all of Navicore's information in the description of this podcast, so if you find your debt is too much to handle, contact Navicore for help. Investing is a hot topic right now, which is great because young people should start investing as soon as possible. The first investing question comes to us from Facebook, and it's from Olivia. She's 25 years old, and she says, I'm young and feel like I have no money. Is it possible to invest on a low income? Here's the thing about investing. You don't necessarily need a lot of money to start investing. It's a common myth that you do need a lot of money to start investing, but that myth is definitely not true. If you're young and you feel like there's no way you can add investments to your budget, you need to know that you can still invest. Don't have the mindset that you'll start investing when you have, quote, real money to invest. That idea you must be rich to invest couldn't be further from the truth. You should be thinking about investment strategies as soon as you start making money. Our next question was emailed to us from James, who's 29 from Pennsylvania, and he asked, the stock market seems so confusing. Could you break down the stock market in a way we can all understand? Now that we've established you don't have to be rich to invest, let's talk about some types of investment opportunities that are for young people. I agree the stock market can be confusing, so I'm going to do my best to break it down for everyone listening. People buy and trade stocks to make money. There are two main ways you can make money from the stock market. Share price appreciation is one way. This is when you buy shares of a company at a certain price. Over a period of time, the value of that stock will hopefully increase, and you'll be able to sell that stock for more than you paid for it at a future date. Dividends are another way you can make money from the stock market. Dividends are a distribution of the company's earnings, generally paid in cash. Companies will pay dividends to share some of their profits. Paying dividends also makes the company more desirable to investors. The more people that like the company, the more they are likely to buy their stock, thereby driving up the value of the shares. To go back to the previous question, there are some low-cost options for young investors to get started with the stock market. An exchange-traded fund, or ETF, is a type of security that ranks an index, sector, commodity, or other aspects which can be purchased or sold on a stock exchange the same as a regular stock. An ETF is a great option for investors on a lower budget because it's an easily marketable security. This means it has an associated price that allows it to be easily bought and sold. Mutual funds are also an alternative for those investing on a lower budget. A mutual fund is a professionally managed group of diversified stocks from a number of different companies. Mutual funds are a practical, cost-efficient way to build a portfolio of various stocks, bonds, or short-term investments. These are great for new investors because you can pick an area of the stock market that you're interested in investing in, and there's bound to be a mutual fund that consists of companies from that sector. Our last question comes to us from Instagram, and it's from Michelle. She's 30 years old and she's from Colorado. And she asks, what other investment opportunities do you recommend for young people other than the stock market? If stock market investing seems daunting for you, try investing in your company's 401k. You can pay into your 401k before tax, which means more money saved. Another reason to start investing in your 401k as soon as possible is because most plans offer an employer match. This means your employer may make matching contributions to a certain maximum. So if you work for a company that offers a 401k, you should be investing in it. You can also invest in your retirement with a Roth IRA. This is a type of savings account specifically for retirement. This account encourages you to save because the earnings in your Roth IRA are tax-free. Once you put your money into a Roth IRA, any earnings are tax-free. As long as you follow the withdrawal rules, you won't have to pay taxes on withdrawals during your retirement. So if the stock market seems like a lot, try investing in your retirement fund. That wraps up this edition of Ask Me Anything. You all had such great questions, which makes me so happy. It's so exciting to see the youth of today be so interested in finances. Finances may not always be the most interesting topic, but it's definitely one of the most important topics to talk about. Being financially savvy is a crucial part of adulting. Thank you for listening to the podcast, and don't forget to subscribe wherever you're listening. If you're listening on Apple Podcasts or Spotify, please rate and review us there. I want to wish everybody a happy and healthy new year, and I'll talk to you next year, millennials, Gen Zers, and everyone else listening. Bye.